Guys, happy holidays to you as well. Appreciate the time today. Urian, I wonder what you make of this ongoing conversation about the difference between goods and services, how stubborn services is, and whether or not there's some level at which the deflation in goods is so powerful we can begin to assume services will follow.
Well, that is a big question, of course, and we know what the leading indicators say about the overall economy. But as you know, the U.S. economy is dominated by consumer spending, and that's really what we need to look at. And it looks to me like the economy will hold up in the first half. Consumers still have some excess savings. The leads and lags of the yield curve signal, are long enough that maybe it's the second half of the year where we should be looking for, a recession or a weakness. And in the meantime, the market needs a lot of things to go right? The market is priced as if the Fed is going to pivot back down to a neutral rate of 3%, while at the same time earnings are going to hold up. And those two things don't necessarily agree with each other, or they wouldn't happen at the same time. So for the market, a lot needs to go right, and obviously the economy is front and center there.
Brian, you've written a lot about growth being on a precipice and sort of looking at what history tells us about equity performance when we do get a pause. The question is, I guess, whether or not that lives up to form this time.
Yeah, we'll have to see, and thanks for having me on. So yeah, here at Allspring on my multi-asset team, the way that we've been looking at the data is we have to kind of break this up into a couple pieces, right? What happens just historically when the Fed hikes and then they hold? That is actually a fairly bullish indicator, right? That period between when they hold and even before the first cut. And 4 out of the last 5 times that the Fed has had to do that, the equity markets have been up anywhere from about like 6% to 12% within 3 months. But it's also been really good for bonds. But then you get into the problem as far as let's fold in the recession risks. What's happened as far as if that's happening during a recession? Because historically, the Fed hikes and then a recession happens like well after the fact. That's where it gets a little messier. And we're thinking about, let's say maybe in the early 1980s, you had that double dip recession period where the equity market corrected significantly. And then actually, when the second leg of that double dip recession happened, equity markets did fairly well. So, it's not a perfect indicator. So we can never say, something always happens or something never happens. Sometimes it does. And it seems like it might be rhyming a little bit with that idea of maybe a double dip recession kind of scenario where the market has done a significant amount of repricing already.
So you're buying stocks now?
Well, I would have to say that it's more of a balanced portfolio, right, as far as we are positive on equity, so overweight. So buying them, yes, we do have a positive outlook. It is a matter of the horizon here, though. We have to get to that hold point first, right? I think that's really going to be the key thing is that February 1st FOMC announcement, what's the messaging around that? Is the end near in terms of the rate hikes themselves, or is it just getting closer? That to us is going to be really a significant trigger for an equity market rally is if we do get that signal from the Fed that they are on hold. So we are adding risk, but I wouldn't say that we're all in on it right now.